And welcome everybody to the last dance of the 6.5 years of Go Markets Inner Circle. The Inner Circle hat is finally being hung up. It's been a great run in terms of some of the things we've covered, some of the distance we've traveled together, and hopefully you've gained along the way. So it's a bit of an end of an era, at least Inner Circle and Go Markets. Be other things popping up. I did invite a few of you Trader IQ guys along. Thank you for popping in. You'll have your own version of this coming along soon. For Go Markets, there's other things on the way, so keep your eyes peeled about what's happening, and both in the immediate future and on an ongoing basis. So whichever way you slice it, you're going to get well catered for. But it's been my pleasure and privilege to be part of your journey in whatever way that's been. So just this important message, just in case you haven't heard it enough from me. I think I've only missed one when I had my appendix out, one when there was a bushfire, and I think that's about it. Maybe a couple of others along the way where there's been technical issues, but missing 4 weeks out of 300 isn't bad, I guess. But thank you. But we are doing a combination of looking at live markets. We'll have a quick whiz around, and then I'll answer any questions, and then we'll go into the session proper. Then we'll be having a look at markets as we talk about things, because they're obviously relevant to markets as we go. But just do your own due diligence on anything you see here. Make sure you follow trading plans. Make sure you manage risk on every trading action. It's entry and exit consistent with your own personal circumstances and financial situation. Thank you, as always. Oh, that's very kind of you. Oh, you've got a virus, Neil. Yeah, let me know what's been going on. I'll see if there's any way I can help. Certainly anything that you've downloaded or any of that sort of stuff, then of course I'll help. David, you're so kind. Thanks, Michael, for that kind of feedback. I really appreciate it. There's a couple of you sent me emails as well, which is very cool. Thanks for the heads up. Thanks for the heads up on the AV Wade. Yes, in memoriam of Inner Circle, Brian. Good call. Hugh, you're so welcome, mate. Hi, Keith, as well. Yeah, Brian, thanks for your email. It was very kind. Right. Anyway, let's get on with it. For those of you watching on YouTube, hello to you guys as well. If you're watching live, if you're watching on catch up, you can still give a little thumbs up. That would be always appreciated. But let's start by just having a look at markets, and some really interesting stuff going on at the moment. Let's start just by looking at what happened last night in the US. So you can see some evidence of rotation out of tech. Has that been followed through on the futures? Well, yes, it has, not to a large degree. But you can see there, gold is booming again, up another 4%. So that bouncing gold after last week's sell-off, which is really due to the Trump nominee for the new Fed chair, who will kick off his tenure May, I think, May or June. He's a little bit of a traditional hawk, which is sort of a bit of a surprise, since Trump spent the last 6 months talking about how Jerome Powell's always too late and he's too dovish for his liking. The yen's got belted. We've noticed on some of the EAs, the yen crosses are doing well. But that's the futures. In terms of data today, Then the data out so far showed strong jobs data coming out of New Zealand. Services PMI, good number out of China. Again, that PMI data coming out of China over the last couple of sessions. The manufacturing PMI earlier in the week was good. Some services PMI elsewhere. It's obviously less influential than manufacturing, but generally speaking, the numbers are good. We are expecting a CPI flash estimate out of the Eurozone, which will be influential. In the next hour. And then later on in the week, we've also got ADP numbers tonight. We've got, and then tomorrow we're into the BOE rate decision. We are expecting no change. Then likewise with the Eurozone. We've got employment numbers coming out of Canada, and then consumer sentiment coming out of the US. Got some elections in Japan over the weekend, which could be significant, and next week. Let's just look at what the headlines are on CNBC. Asia, positive session in Asia, which sort of didn't follow that US lead at all. Let's talk with it because it was tech stocks. So we saw a weakness in the Nikkei. Some interesting headlines. Just keep an eye on these. So AI chip sales to China have stalled. I wonder what that'll do to NVIDIA prices tonight. And then as I said, the major news is really gold. Shit. Can I just? I'll just have to briefly put a pause. So what we've got is a situation where US markets are looking pretty flat tonight so far, with very little data. So it's going to be sort of driven by some of these headlines coming out from various parts of the world. Be interesting to see if we get a continuing sell-off of tech. Worthwhile, obviously, having a look at the Nasdaq. So let's do that right now. So here's the Nasdaq futures. You can see there that sell-off last night. So essentially, what we're in a little bit of a range, but we have got higher lows, higher low, higher low, higher low. Okay, and then we've got a potential resistance there at 25,800. So those are the key levels just to keep an eye on. In terms of the US dollar, that's had a bounce after that announcement for the Fed chair nominee, but it's sort of paused over the last couple of days. And gold has been all over the place. Here's gold yesterday and today recovering to some degree. This big drop that we had a couple of days, so we've retraced about 50% of that. If we look at copper, you can see copper is pushing back against this 608 level, which is technically important. We had one day that closed over that, shot all the way up to 658 before coming back down again the next day on the back of that news. So really sort of unusual market at the moment, being chucked around all over the place, and that's quite key. If we look at oil spiked on the back of news that Trump was sending a flotilla of US Navy ships, including big aircraft carriers, in the general direction of the Middle East, with a potential Iranian foray. 66 is the top, that pulled back to 62.50. 58. So that's interesting to see where we're going next on that. The EIA data should be out tonight. And if we look at Bitcoin, Bitcoin hit its lowest level yesterday. That was 72,832, which is a lowest move all the way back. You've got to go all the way back here to October 2024. So we're now back in Trump election territory. Remember, Bitcoin spiked after Trump was elected, and obviously he took office in January, pulled back. But that's an amazing drop in Bitcoin. If we just sort of look at the distance, 42%, or more than that, 42% drop on Bitcoin since the highs that it hit in October. So in terms of crosses, as I said, the yen looks really weak today. And let's just have a look at a couple. Here is the US yen, bounced off to 200 MA, really nice sort of move. So a couple of things supporting that, but it's obviously broken through a key level, possible target of 157.76. For those of you part of, for those of you part of the chart of the day was the Aussie yen. And the trade was a potential trend continuation of 109.67. That's your trade like you guys. Yes, you're welcome. And that's already from that point going up 40 pips. Daily context always important, but you're going to struggle to find a daily context which is relevant. Even going all the way back to so this was the last port of call, which was sort of interest. So you can see here the high on that month, which was July 2024. That was before the BOJ surprisingly raised interest rates, which is why we saw that drop. But yeah, so that's the last time it was near that level, and we've even surpassed that. So a really bullish move on some yen crosses. It doesn't matter what you're looking at, it's going to be the same. Your key trick here is really look at the GBP pound yen. There's a monthly chart, there's the daily chart. Today it's breached key level at 213.65. And look at the hourly chart, you can just see it's gone up and up and up. Maybe there's something with the Japanese elections that's impacting that. So outside of the yen crosses, it's sort of difficult to plant your flag anyway. Obviously, the RBA raised rates sort of as expected yesterday, which is not really. I think it was primarily priced in. If we look daily at the daily chart on the GB pound Aussie, for example, you can see this has been in downtrend. Struggled a little bit. Again, this is hitting multi-month lows. We haven't seen this level since back here in November 2024 as well. So strength in the Aussie dollar continues. A little bit of support today, but this doesn't look convincing at all. So we've got lower highs and lower lows on every retracement. So again, could be moving sort of general downwards. We've got a nice line in the sand now. Really short-term range in between 194.90 and 195.30. So move through that. Again, could test that level. We could see a sell-off again to go all the way down here. That's about another 45 pips. So I'll be keeping an eye maybe on this for a potential short, but then again, crosses are worthwhile. Potentially partial closing if there's any pause. On the ASX, just a couple to watch for tomorrow. As I said, the ASX had a good day today, which was somewhat surprising. There is our dashboard. That's pretty cool, isn't it? That I developed. Now, what I am interested in is finding which. There we are. So here's the ASX scanner. Bank's looking quite strong on the back of that rate rise. NAB, for example. You can see here that NAB had a good session today. It's still a way off key levels. 44.75 looks as though it's an interesting level. Uranium stocks still looking really quite good. We have had a retracement. We did get a move up today in DPLO. 291 looks like an area of interest. Let's just keep an eye on that over the next few days. And coal stocks. I'll reach my limit. I might have reached my limit. So there's a limit to the number of trades, number of charts you can have open. I've been busy back testing. Let's get rid of those. Let's go back here. Right. S32 looks still strong. That's actually a trend continuation. Okay, I'm going to make that my ASX chart to watch tomorrow, S32. This is all-time highs, I'm pretty sure. Oh, no. No, in fact, it's got a really nice line in the sand. That's 2021. Really nice line at sand at about 530. From current price, that is 12% up from here. You can see why this is an area where you might just want another little confirmation of continuation simply because of that resistance there back in January 2023. So there you go. There's some things to have a look at. Right, okay, adapting to volatility, liquidity, and regime shifts. So the core idea really is markets constantly have change. Volatility can expand, can contract, liquidity can be increased, decreased, and trends rotate from one to another. And obviously we've got many indicators that we've developed to try and measure that. And in fact, multiple indicators, custom indicators that measure multiple things at the same time to create a threshold for action. It's really important because what this means in practical terms to you as traders is that the same strategy can produce very different outcomes in very different market environments, depending on how these three things move. So your consistency doesn't, if you're looking for consistency in results, it can obviously be put at risk because of this. But if you're looking for an edge, if you're looking for a system that's comprehensive, then it should take into account these three things. So adjust to the conditions you're trading. Now, at a simple level, that may be a position sizing. So if volatility is ultra high or ultra low, neither of those are particularly good. If regime has shifted, we'll tend to find that a sideways type of movement on a longer time frame doesn't lend itself quite well to mean reversion, but doesn't lend itself quite well to trend trading. So what we're going to do is try and just pick these up a little bit, and then I'm going to give you a list of things to just keep an eye on. So if we look at volatility changes, first of all, it's the speed and the size of the movement, so quiet versus explosive markets. And we see some of this is natural market behavior. So for example, if we were to look at GB pound Aussie, for example, we could just look at volume as the gauge of that. So you can see Asia. Let's take the MACD off. But you can see in Asia, if you look at the beginning of the day, the volatility is usually at its lowest for the day. A few exceptions. Even when markets are choppy, you can see there that most of the time volatility is, it's all right, so you can see here. Volatility is sort of low at the start of the day and at its highest usually when the US market opens. Let's try another asset class. Let's try gold maybe on a, let's try on an hourly chart. Again, lowest point is often in Asia. Sometimes it's not. This is an interesting move in terms of you've got volatility going down if we look at the ATR. But for most of that time, markets are going nowhere. Okay, so we're going to drop off initially. Now, a drop off in volatility plus an up move usually is a sign that the trend isn't going to be particularly long lasting, just as an example. So once again, you can see here that we had a little bit of a pickup really early Asia, which sort of corresponds to that. That's a tick. But then you saw it flattening off and even decreasing now. So this combined with this suggests that this trend is a little potentially exhausted. And it doesn't matter which asset class you're looking at, it's going to be the same. We can look at, if we look at NASDAQ futures, let's just have a look at NASDAQ futures contract. Again, you'll see, even if volume is okay at the start of the Asian session, then volatility isn't necessarily rising. Flat again, US is when it happens. US is when it happens. So again, if we look here, this is an unusual move, because we've got a really strong up move with a decrease in volatility. No such move here. There's that big drop off during the course of last night. But you can see here now again a state whereby the trend, the bounce of that of all volatility is high. It's obviously a 14 ATR. Let's just change this to a 6 ATR. And you get a greater reaction. So you'll see that move here is associated with short volatility. Interestingly, it's a good lesson actually, in that often in terms of if you're comparing price versus volatility, often a shorter ATR, for example, a 6 is a better gauge of what's happening because it obviously is focused on the last 6 bars, not the last 14. So you see with this up move, we've still got a drop in volatility, but it's not as significant. And we've got to pick up to what in these last few candles. With this is just looking as though it's going to sort of retrace and come back and test this level here, which was the low of yesterday and the low of the day before. So volatility has got to be seen in context, and it's a case of all of these. Not only in terms of, is it the norm at a particular time of day for a particular session, and with particular events going on, you'd obviously expect increased volatility around events. Also, of course, it's context to price. And at this stage, price is suggesting it should move downwards. Is it worth comparing to ATRs? We've done actually this in the past, Simon. It's a good question. So one thing you can do, because it is not something that we've really explored in any of the EAs, but if we want to put an ATR, what you do is you drag one on top of the other. Let's make it a different color so you can see. So one's a 14, one's a 6. And you can see they function very differently. You're going to get a, so theoretically, a cross of the short term over the longer term, in the same way that a cross of a short term over a longer term MA is an indication of price trend. It's maybe an indication of volatility trend. You probably take these out a little bit. So you might, for example, make this a 20. And you might make this a 5, let's say. You want like a much lower than 5, because otherwise it just becomes a little less. So the 20 is the fairly sort of standard stuff, whereas this signifies a short-term change. So you can see here we've got that short-term change here, which resulted in this. We've got the short-term change here. We've got a long-term change as well in that. So that it might be worth looking at. That's the way to do it. So drag another on MT5 anyway. Drag an ATR on top of the existing ATR and then just change the settings. So a good call from Simon. well worth having a look at. So you can see now that that 20, or that short-term ATR is much lower now. It's crossed back underneath the medium term with the 21, and that corresponds to this trend looking a little exhausted, potentially. So certainly worth considering. Good call. So why is it important? Well, if you're using the ATR for any of your calculations, so a lot of people use ATR for calculating stop losses, for take profits, for example. Which obviously influences things like partial closes, may ultimately impact on win rate if you don't take it into account. But its major implications are on some of the calculations that you use to make decisions on some of the trading styles that you take, be that you need, or whether you enter a trade at all. Some people would suggest that you only should enter a trade if volatility is increasing. And many of you have seen the volatility, velocity, volume indicator that I developed a little while ago. Again, that's based on the same thing in terms of high volume, high volatility, and high velocity tend to be ticks. If they're all together, then it tends to be quite a positive signal that a trade may be worth having a look at. So if you get low volatility, you get tighter ranges, so you need to set smaller targets. During a high volatility market, wider stops, potentially fewer positions, larger swings, and as I said, you can do this. One of the key things to keep an eye on is, particularly if markets are moving from low to high, because direction of volatility is important, not just the fact whether it's high or low. So it's directionally is probably more important, actually. So if you're altering stops, then your position sizing should automatically alter as well. So if, for example, it's a high volatility situation, which means your 1.5 ATR pushes your stop loss away, that may, if the market is, it may be that you should test, it may be that you should test the legitimacy of actually increasing your, you would normally decrease your lot size if you move your stop away. But you should, it could be one of the things that you test, if that makes sense. In terms of liquidity, so liquidity is all about participation, really. It's about how many people are participating in the market at a particular time. So this impacts on spread. It impacts on slippage, which we obviously see, and potentially gaps, which we see or sometimes on market open, but also during times where volatility shoots up to the sky. So depending on the situation will depend on the implications, really. The degree to which execution matters will be dependent on how often you trade situations which can be categorized as a significant change in liquidity, but also, of course, your trade size. If you are trading 0.1 of a lot and there's an execution difference of, let's say, half a pip, then that's going to make very much. That's not going to make very much difference. But if you're trading 8 lots, for example, then 0.5 a pip can be quite significant in terms of dollars. Obviously, slippage is something that is part of particularly FX trading, and gaps are again any asset that closes on a Friday and opens again on a Monday is potentially subject to gaps. Or it closes one day, opens the next, so that where it doesn't trade 24 hours. So it's all worth keeping an eye on. Spreads and issue spread will vary during the course of the day, and we're obviously doing some work on that, thanks to Wayne. And we're looking at this in some more detail. But it may be part of your exit decision making that we're not only coming up to an area where economic data is released and therefore there might be increased chance of slippage, but more importantly, potentially is the fact that as you move towards the back end of the US session, perhaps even in the early part of the Asian session, spreads are quite wide, and that can make quite a difference, not only in terms of what you gain, but what you can lose. If there's a gap and that the spread's wide, it means your stop will be taken out at far lower level than you perhaps thought it would do. If there's thin liquidity, bottom line is you get worse fills, more false breaks, and you get stop under easily seeing where you're placed. Spread and slippage increases risk, of course, just for the reasons I've already talked about. So if you are, so really the two things you can consider are avoiding low liquidity sessions, either through reducing the number of entries you have during those sessions, or even indeed considering exiting before that time, or reducing your position size. So if there is a degree of spread widening, then if you do get just taken out, you're not going to get taken out with as significant a loss. So that's really important. But finally, and possibly one of the most influential, is regime changes. And by regime changes, we talked about this in a different webinar. We're talking about market context. Market context is all about what regime we're in. And so it's the dominant behavior of the market. Is it trending? Is it rotational? Is it choppy? It's got range bound. And what regime is it? And what regime does it change into, obviously? I've already referenced that each type of market will favor different types of strategy. So mean reversion suits range bound markets, for example. Breakout doesn't suit breakout trades. More fake outs in markets which are range bound on time trades. So generally speaking, if you've got a trending market, breakout and pullback trades work better. So if you're entering on retracements, only will ever work if the underlying trend over the longer time frame is up. Rotational or range bound mean reversion performs better. Choppy markets are very difficult to trade. So really, if your market's entering a choppy phase, and would suggest that what we're seeing by choppy, I mean this sort of behavior, where you've got potentially a wide range and fast moving or high velocity moves. You often get indices in a period of choppiness. So you could suggest that this is quite choppy. That is quite a wide range. Let me just measure it. Although generally speaking, it's obviously still an uptrend, we've got higher, low, higher, low, higher, low. This range is still 3.8%, so nearly 4%. That's quite a wide range for it to trade in. And more so if you take this into account. So choppy markets are very difficult unless you're trading shorter time frames. And even then, quite tough. So the trick is, of course, to measure what these are. So we've got tools like this, which give us regime changes. So it looks as though we're up high volatility. That's still that. Then we've got low volatile because we've had that pullback, and that's what we see. then we get a choppy market. You can see it's starting to chop up and down quite a lot by the time it gets to here. And then we move fairly quickly into high volatility, move downwards. So knowing what these regimes are is useful in terms of, well, look, we can compare that versus what it's doing on the daily. So if we see something on the daily chart that suggests that it's a choppy market, and on the shorter time frame, it's range bound. It doesn't suggest that trend. So breakouts are going to be particularly good during those periods. If that makes sense. Just keep an eye on it. I'm thinking I'm answering questions on the way. So I think you answered a couple of them on the way. So at a really simple level, you can just look at a multi-time frame, some sort of correlation. Let's just see if we can find. So the US yen still strong. The regime's on another. Of course it is. Okay, so if you continue to trade the wrong style for the wrong market, then you'll often, one of the symptoms you'll see is a succession of small losses. So just be aware of that. So really, if we boil it down into what is the mistake, or what is the key area for development for many traders, what happens is people trade the same strategy, the same size, the same expectations every day. We've already stressed why that isn't the case. In that conditions will change, be that due to primarily regime change. In order of preference, to answer that question, I would say regime change number 1, volatility number 2, liquidity change number 3 for the most damaging, potentially. So your results going forward and the expectancy related to specific strategies can decrease over time. So the reality is that there may be nothing wrong with your system. It's just that you're not taking these things into account. So they're just failing in the wrong environment, not because they're bad per se. And so what it means is that you need another set of filters in there that says, should I trade or should I not trade? I hope that makes sense. So what we need to do is we need to shift from looking at strategy first to looking at environment first. What's the trading environment? What's market context? What's market structure? Market context includes volatility and regime. Market structure takes into account sort of key levels and swing highs, swing lows. So what you need is some additional filters, and insert these into your systems accordingly. So taking your trading plan to the next level, essentially, in simple terms. So what I wanted to do is perhaps give you something to walk away with, and have a practical checklist before every session. So you'd start by potentially looking at volatility and asking the question, is the ATR expanding? Are you getting wider, or is it contracting? Moves clean, or is it erratic all over the place? And then how is that going to impact on how I adjust my stops and targets accordingly? Even if you're not using the ATR, let's say an ATR multiple, which is good because it adapts to time frame and current state of volatility. Even if you're using some other method of doing this, some people use a percentage drop, some people would use a points drop. But even if you're doing that, then adjusting that accordingly based on what's happening to volatility is important. With liquidity, really, it sort of all comes down to keeping an eye on the sessions you trade. News or events, particularly scheduled ones, are likely to impact order flow both before, during, and after. And are you entering a period in the day when spreads are widening or tightening? And is slippage normal? That, as I said, may often change significantly around fast-moving markets, often due to data. From a regime, are you in trend, rotation, or chop? Are breakouts following through, or are they fading? There's a school of thought that thinks you can tell the likelihood, one of the variables you should perhaps continue, the likelihood of a breakout being actually a breakout rather than a fake out, is what was the last one, or what were the last two like? Did they break out, or did they make an attempt to fall back? And of course, we've got a little tool. Again, sure it's me too. No, maybe you've got. My having problems overriding. This protocol, what I'm doing that for range identifier. There we go. So we've got this little tool that sort of identifies ranges that we're in. So you see there was a fake out there. This is a nice move once it broke out this range. We're in one now, so it's drawn two lines that things are very important on the GB pattern. Also, you can see it's pushing back up. But that level there looks of interest. So around about 195.50. Yeah, drop me a line. I'll let you know how you can get all of that if you want. Okay, Neil, I'll have a look at that. What I can help with is I can help you load anything that you need to load, all of that sort of stuff. But generally speaking, you need to get the setup of your. You need to re-download MT5 and then use your existing password and login and password to be able to get into that. So you're essentially resetting your account, and then you can load on all the indicators and stuff that you've got already. Now, again, I can help you with that, mate. So regime. So what regime is it? Breakouts point through a fading course. You can do that, and is momentum persisting or stalling quickly? So again, you can just sort of, if this is part of your regime, then you would sort of have a look. Within the entry, there's a multiple time frame confluence indicator. Sorry, just momentum course. Right. So we can just stick with MACD if we want to. So again, we'll sort of give you. I'll try and explain this in some. Try and put the pieces together. So that one of the things we've talked about previously has been an exit is when the signal line crosses the histogram line. So you can see here on this candle here, not only we've got a fake out, but we've got the signal line going across. So whichever way you slice it, you get out there, you wouldn't wait until it was down here. You can see here momentum's fading. The histograms histogram length is looking as though it's done, and it has done for a while, to be fair. So you'd want to see this cross zero for a start, for a potential uptrend. and then the signal line being below the histogram as it was here or here. So look, use this to sort of say, well, look, is momentum fading? So as you see that signal line crossing, it's a good sign that something is not well in the world. Let's just put it on here. Or something's about to pause. So we can see here, as soon as that signal line crossed, it went into a range. Same here, signal line crosses, goes into a range. So it's often a sign that something's going to move into trend to sideways trend. So that's why you would have a look at it. You would have a look at momentum on the open positions you've got and ask or entries you potentially consider and say, well, is momentum still looking, is it increasing? You can tell that because the histograms are getting bigger, or is that signal line crossing already? And then in terms of your risk management, then the overall market condition should give you some clues as to whether you should scale up, scale down. By scaling up, I mean accumulate. By scale down, I mean reduce your position or partially close or sit out completely. And answer the basic question, is today an opportunity day or a capital protection day? And what I can do if you want. Does that sort of make sense to everyone? Got an idea. Let's see if I can do this. Rather than typing all of this in, checklist. So you can have a look at this and decide whether it's something that might work for you. So what I've done is I've created a little image file of this. You can see there I've snipped it. And I put it into Handout. So if that's of interest to you, you can download that now. You're welcome. I hope that's useful in some way, shape, or form. But it's really worthwhile doing this for those of you who are AI familiar. I would plug that in and expand it a little more for yourselves. Just as a pre-session checklist, and as I said, you come up with the final answers. You're going to be increasing or decreasing positions accordingly, and maybe ultimately set thresholds for all of these. Sense if you did that. So it's all very well saying, is it expanding or contracting? What's the action you're going to take from that? So that's how it makes sense. Cool. Okay. Right. Have I killed it? I know why it's not moving forward, because I'm still on coin mode. There we go. So finally, just remember, this is really worth writing down. Of course, you don't control the market. We all see the same. This fits in the basic principles of TIQ as well. What you are in control of is how you respond to it. Putting things like this in place that consider markets are doing and therefore what might happen next is a critical part of your ongoing trading development. And we have covered things like this before. So if there's anything at all that doesn't make sense, then you can always drop me a line on either email address. Of course, I am with Go Markets still for right now. It's my.smith@gomarkets.com, and if you're some of you have got other emails, etc. I think so. I think so, but thanks for asking. Good, as I said, David. As you've said, David, good thing to add to your trading toolbox. So let's draw a line under Go Markets in the circle. once again, if you missed the start, a massive gratitude for being part of this journey. It's a pleasure to see. Look, there's quite a few of you that have popped along that haven't been here for a while, and there's a chunk of people who pop in regularly anyway. Either way, it's wonderful to see you here. It's been a pleasure and a privilege serving you on the sessions. I hope I've added to your knowledge, your confidence, and maybe a skill or two along the way, as well as understanding markets a little better. My job as an educator is always to stretch a little bit, to chastise when chastisement is needed, to encourage and support when encouragement and support are needed. And I thank you for being a really wonderful group of people to work with. So you guys take care of yourselves, trade safe, and you know where I am. As I said, I'm still around. In about the ongoing markets beyond slide on Q. Saran, it's a pleasure. That's really kind. Yeah, it is the end of the era. Yeah, onwards and upwards, absolutely. Cheers, Simon. Did you? It's a shocker, isn't it? You'll hear me often, Sonia. Don't you worry about it. Yeah. Mike, you're so welcome. Peter, you're very, very welcome, mate. Thank you very much indeed. I really appreciate that. So, for one last time, you guys trade safe. I'll love and leave you. Enjoy the rest of your Wednesday evening. Thanks, Shane. And I'll see you somewhere, sometime on another session. Bye-bye for now. Thanks, Neil. Cheers, David. A list of pubs where you might see me again, Andrew, I'll be distributed. You're welcome, Bob. Cheers, Sonia. Catch you soon. Bye-bye, guys.